We are going to discuss about investment banking classes. In last video we are completed that types of bonds in last video. If you want that video, I will put in that in comments box. So now come to, I will discuss about the equity market in investment banking classes. So welcome to investment banking classes. So what is there in equity market? So equity market, we have primary market and secondary market, corporate actions, derivatives, equity research, etc., etc. They will some concept I will include in of all the far reach away. So what is this primary market? So in equity market, they will start with primary market. What is there in primary market? In primary market, how to raise the capital, issue shares, how to issue the shares, and at what price we will need to issue the share price, and who can help to raise that capital. We are This concept will be discussed in primary market. So what is there in primary market? How to raise the capital, and how much shares we need to issue, and at what price we need to issue, and who can help that capital. And after that we will go for a secondary market. In secondary market, intermediaries in the market, or they will place the order in the market, and they will settle the trades whatever they happen in the market. In this secondary market we will discuss about this cases, that is intermediary related. After that we will discuss about that corporate actions. What is there in corporate actions? For what is mean by corporate actions means whatever the action or event taken by the company, it will impact the investor. It's a securities or a share, number of shares, etc., etc. The corporate actions will be dividend or bonus shares, right shares, buyback, etc., to create wealth to investor and increase the share price of the in the market. They will take this corporate action by the company. And after that we will go for derivatives means to protect from market risk or losses. We will go for derivatives, her hedge contract, etc., etc. In derivative, there are investors can use the contracts or future contracts, options, swaps, etc., etc. In derivative concept we will discuss this forwards, futures, options, swaps. After that, equity research. Research means that these persons or this team will predict the growth of the business by understanding the financial and business growth. So find a right company to invest to. So normally they what the companies will do, pull the money from the public and invest in the companies. Based on high companies they will reach. So for that company investment, they will have the team of equity research. So the equity research work will be always predict the growth in the business by understanding the financial and business growth of that company, and they will get the good company for the purpose of investment. That is the equity research will do. Now I think for example, for if you started any company, if you have shareholders and you have net profit, in net profit they may be capitals, return on equity, number of shares, EPS will be calculated. In financials, I think financials, you assuming you know the financial details, what is there in financial statement of operations, financials. In statement of operations we need to find that EPS, diluted EPS, etc., etc., and per share price. I think that all concept will be clear for you. And so if the sell the shares at 120 rupees, if the actual value will be 100 rupees, they are selling for 120 rupees, what is the profit and what is the small capital, and what is mean by PE, that is a price earning ratios at capital or venture capital. So they may decide based on the worth of shares. So for example, what is money required, what is the total value of the company. First, if you want to enter in the primary market, first we know the company's valuation. Then we will go for primary market. So for that, what we require now, for example, company will require 5,000 crores, and they may issue number of shares will be different, and now they will decide what is the value of the company as on today, and what we means old issue what is there, and what we need that new issue, and what is the outstanding shares in the company, and what is the share price now, what we will issue at new. For example, if you take the company recently, Tata Technologies, I think Tata Technology went into IPO. I think they kept the price rate range will be 475 to 500. So that price range is there now in primary market. How they calculated that of price range, and they are issued some large size 30, and they issue some shares. So that number of shares, how much shares will be issued, being decided in primary market, and they raise this capital from PE funds like Motilal Oswal or Edwell, Kotak, KKR, Blackstone, etc., etc., QIB persons, NII persons, FII persons, DII persons. So they will issue in public issue, and they proportionately allocate this person. So we will see that persons in future cases. So if the company wants to write some amount, after sometimes it may difficult to rise from one or two people. So if you want more money, if you are asking for 1 or 2%, it is highly not recommended, because only depending on 1 or 2%, it is hard to the company to get the whatever the money required. So it is better to go for the public. So when if you go for the public, there are number of persons they may insure. For that purpose only, companies will go for IPO, initial public offer. And sometimes we need see that FPO also. What is mean by FPO? Follow public offer. Mean if you are issuing at first time, it will become IPO. If you are issuing second or next time, it will become FPO. And here they may companies in public issue who buy the shares and who sell the shares, means either old investors like promoters or PE funds, they can sell their shares. It will become offer for sale, OFS. And if company creating new shares and they go for a sale, and they call fresh issue. So promoters selling their shares, it is offer for sale, and company issuing newly, it will become the fresh issue. So now when company is deciding now, then the company will need which they can create any number of shares, or investors how ready there, and what is the tenure, what is the potential of this business, they must decide about this cases. So every company should go for IPO, means it is not cases they may go for as interest of the company, and it is not mandatory for every private company go for IPO for the listing. So company want to listing, they may go for a direct listing also. It is not required mandatory to go for the public issue. In the primary market, in this market, companies like that Zomato, Swiggy, this is selling the shares to the public for the first time. If going for the first time, or yearly companies may have sold shares to other like venture capital firms, private equity funds, etc., etc., but not to public at large. This process of selling shares to public and raising money for the company is known as initial public offer. So when you are entering into public, so you are asking money from the public at first time, it will become the IPO, initial public offer. Other than IPO, what are the source will be there for the company, means if the company want to expend money, so at any time the company can choose if they want to raise capital from a debt issue or equity issue. So if companies they may decide for equity, they can sell shares to few parties like private equity funds, venture capital funds, or sell public through IPOs. So company may choose any market, that is private equity funds, venture capital funds, or sell public through IPO. So nowadays, most of the company will first selling the shares to PE fund, that private equity funds, like after 5 years, 10 years, they will go for IPO. The normally cycle this is going in process. So if you have a IPO process, company always raising more money or capital by creating new shares, or old investors may like PE funds are selling their shares. So the company can do both in IPO. That they may issue the fresh issue, and the promoters will go, and old investors may like to go for P. And if company wants both options, they go for both option at a time. That is single point of time. They may go for this case. So if company is creating new shares and selling to public, that is called as fresh issue. It will become fresh issue. Example: Paytm raised 5,000 crores in IPO or 3,000 fresh issue. This means if the company was 7,000 crores and has capital before. So for example, if company has 7,000 in before, and now company is going for a rise 5,000, and it issued for fresh issue 3,000 only, and they how after capital, what is the capital will be there, they went for IPO only 3,000 now, so 7,000 plus 3,000 will become 10,000. After that, e-company, and they will allow the remaining 2 crores, 2,000 crores, whatever required. They may allow the old investors like PE, that is private equity funds or promoters, they may sell their shares in IPO. And this is, if the promoters will sell their shares, it is known as offer for share. If the company is issuing at the first time selling their shares in the public, it will become IPO. So in this case, investor name is changing in company and share capital is not increased. And what is the role of investment banker in IPO? So if the IPO is happening, what is the role of investment banker? Investment banker means, here investment banking companies like JP Morgan, Morgan Stanley, etc., they are main parties for this IPO process. They can help the companies for this IPO process from the beginning till money is raised from the public. So they will give the support to the company, and they will complete this IPO process. And here, what is the company's role of investment banker means, to prepare the prospectus. So they will prepare the prospectus and to get the approval from regulatories like SEBI. And these IB companies will help that companies start going for IPO. So they will prepare a prospectus, they will get the approval from regulatory like SEBI, and they will go for IB companies will help in companies IPO process. And they will also ensure that company following all rules and regulations related to IPO, like how many shares to be allotted to retail investors, how many shares to invest to HNI, that is high net worth individuals, etc., etc. What details they must kept in the prospectus. So these all matters will ensured by the investment banker. And these investment banking companies create awareness to investors through roadshows, presentations to mutual fund managers, etc., etc. So they will give the presentation to mutual fund managers, and some companies will give the startups, they will need money, and they will give the money by when the fundraisers have interested. So by that creating that interest, investment banker will give the presentations to them and road shows to them and give the awareness to the investors. And if the company is not able to sell these shares offered in IPO, if that IPO became the failure, so the company need to refund that amount to investors. So when company is not able to raise amount in the public, and he already some persons will pay na, that amount will be repayable. And that in this case, the IBO plays a crucial role. For example, as far as companies act in as related, they must go a minimum 90% of shares should be subscribed. Then only will go for the further. If 90% is not subscribed, then company is not allowed to go for further. Then the company need to refund that amount whatever received for that period. So at that point of time, investment banker will purchase that remaining deficit shares which are not priced by the investors, and they will complete the process here, and they will go for underwriting. So when the less is there, they will go for act as a underwriter, and they will buy the unsold shares. And for example, if the company issued 100 lakhs and 40% was subscribed by the public, and company must require 90%, only 40%. So now company is required to repay that 40% to public who have paid the money. So to avoid that, what the investment banker will do now, that he will purchase that remaining 50, I think 40 and 50% or 55%, he will purchase it, and he will take underwriting commission. He will sell in public, and then company will not required to repay the amount, and they will pay the underwriting commission to that investment banker. This is the deficit case. When some cases over subscription will be happen, what can do in that over subscription time? So if the company issued 100 lakh shares and company subscribed 110 share capital, or 110 investors were invested, 110 crores was received. In that case, they allow the investment banker will do that green shoe option. He will utilize that green shoe option. In green shoe option, they will fix the share price of for IPO by discussing with the management. So by discussing with the management what is the price would be required, IPO will try to get that price by going with green shoe option. So it will help the company the share price in the market by using the green shoe option, etc. Now, in the IPO, the company always with the price. So, for that purpose, company need to go decide the price. So, for deciding that price, company has two options. One will be fixed rate system, and another will be book building method. If the book fixed rate system means it is less popular in IPO, that is the company Tata company issue na. For example, 100 crores they are issuing. For that 100 crores, one share price will be 500. They decided now 500 single amount they decided, it will become fixed rate system. So here they will follow this system. They have to fix the price, and if investors is okay, then he will purchase that shares and submit the application and buy that shares, and else they will ignore the IPO. Or in second type, book building method, that is in book building method, this is the most common method used by the company. In recent also, the Tata Technology company issued in price range 475 to 500 rupees. In this case, company will fix a price range like 400 to 550, and that yesterday also that company is there Downs company, that stationary company also issued in range prices only, and investors can bid for the rate at which they would like to buy. So Tata Technology issued in 475 to 500. Now investors may choose in between that price, and company after that whoever pay the more amount, they will select that person first, and after that they will select based on the lot system when the over subscriptions is there. So example, if the company want to sell some and received more applications, they allot a share those persons and ignore who have paid the less amount, they will reject that application. And if most all the company bid the price lower prices bonds, so company will fix that price. These systems will help to discover the demand and then fix the price. If company receive application for less than what is required in the regulation, that company will go for underwriting for this IBO, investment banker. If the company get over subscription, the investment banker will do the that what green shoe option. In green shoe option, the price will be fixed whatever the price would required, and here the company will invested green shoe option. Na? What is green shoe option? I think so. Just a second, yeah. Book billing price means that range will be there, and here we discuss some case that in book billing cases they will go for range, it is okay, and company will issue the shares in a proportionate for different persons in different ways, so they will allocating the shares. These companies will need to allocate the shares to QIB, NII, RII, etc. What is this person QIB, NII, RRI, etc. What does this mean, or how they allocate will be happen if the over subscription is there? So, for example, while raising the money, this company should keep some portion of shares to retail investors also, so their participation in the market will be good. This retail investors means who is public like you and me, and it will make securities market to grow, and common allocation percentages will be there. So for example, QIB means qualified institutional investors. Here the qualified institutional investors means the investors who have qualified, and they are not the individual person, they are the institutional investors like mutual fund, hedges, insurance companies, etc will fall under this category. Generally 50% of issue size is allocated to this type of categories. An example, if a company is selling 1 crore shares or 50 lakh shares are allocated to this category normally. And allocation, if there is over subscription in this category, they will allot on proportional basis. If they have over subscription, they will go for in a proportionate way. For example, if in this category they have received the application for 10 crores, allocated shares will be 10 lakhs, over subscription will be 10 times. If we see in the companies like yesterday was completed that Dow's company IPO, I think it's 4 times subscribed, and that IPO Tata Technology, I think 13 times they subscribe. That 13 times or 14 times or 10 times means what is that time means? For one application you have got the 10 application. 14 times means for one application you have got the 14 application. If you company sell that 15 times, 50 times means for one application they got that 50 applications. Like same has government jobs, so government jobs will issue 20 jobs and application will be 20 lakhs, means government may say that 20 lakhs times, but unnecessary they don't disclose this type of case. We will go in the stock market only. So QIB means these are qualified institutions like mutual funds, hedge funds, insurance companies, and they will normally 50% they issue for this qualified institutional. And after that, non-institutional individuals, non-institutional investors means in this category will fall that high net worth individual, that are NI, NHNI persons, high net worth individuals, etc. People who have applied for more shares but not institutions. Here there will not the institutions that more high net worth individuals like MS Dhoni or Kohli, Sachin Tendulkar, etc. These persons have more net worth. These persons known as high net worth individual persons, and they can apply for this. So normally if you are applying for share worth of 2 lakhs and above, then your application will be considered as in high net worth individual and allocating the proportionate basis. And after that, retail individual investors means a category being belonging to retail investors applying for shares worth of less than 2 lakh rupees. So who are going for less than 2 lakh rupees, they will fall under retail institutional investors, around 35%, I think so. Company may allot for, if there is a oversubscription, allotment will be going, a company should allot at least one lot for all the applications they will try. If a person applied for 3 lots or 4 lots, there is a oversubscription that I tell that one share, one application, one share, 5 application will be there. At that time, company will try to give at least one lot to that person and 4 lot will be rejected at that given case. After that also, if there any applications is there, they will go for any lot basis, so lottery basis. And if the applications are 1 lakh and less than 1 lakh, all they give minimum one lot person to one person. And if the application is more than 1 lakh, they will decide the least eligible investor based on the draw of lottery or lot basis. And we have discussed that green shoe option. What is this green shoe option in IPO process? Green shoe option means this is an option available for the company to stabilize the share price in the market post IPO. So after completion of IPO, the company want to stabilize its share price in the market, then it will choose this green shoe options. Most of the time, if investors are more expectation on the company, the issue will be oversubscribed. Oversubscribed means that 14 times, 50 times, 60 times. So oversubscription. Why the reason for oversubscription? Investors will expectations will be high in that company. If we see the Tata Technology, I think 50 times will be subscribed, I think so. And the lot size will be 30 and share price range will be 475 to 500. And after the subscription date, when the companies completed that process, the price will become 1300 rupees and the next day it will become 1200 rupees, etc. Now, so the persons who have more expectations, they will try to get the more large in the market. That will create the more subscriptions. When the more subscription is there, and company will use this green shoe options. So good listing gains, again on the date of listing shares in the stock exchange. At times this may not happen in the market, or share price can be decreased. So this share price decrease in the market can impact the image of the company negatively. So they can impact their future fund range saving, etc. In green shoe option, what can go for, what can do for to stabilize the price? When investors applied for more shares, allot shares up to 15% more. So 100 shares issued, the company was issued 100 shares now, they will go for another 15%, up to 15% they have option originally planned. So 100 plus 15%. Example, company plans to sell 1 lakh share and they will now go for 1 lakh 15 share, 1 lakh 15,000 shares. And this extra 15,000 shares allotted for promoters take to the public, and the merchant banker or the investment banker have option to buy this extra shares from the public and return to the promoter if the share price is decreasing. So here the investment banker will purchase from the public and they will sell to promoter. And here merchant banker, for example, a shares allotted 70 rupees per share in IPO, they will trading at 600 rupees after listing. So when investment banker will buy now, when buying prices was there, when the buying person is there, more persons is buying, the price will go to high. So when allotted 700 and price became now 600, so company want to increase that price. So this investors, so investment bankers will try to buy, and when more buyers will be there, the price will automatically reach to high prices. So when the price is became 700, okay, they will reach that portion, and the share price increases in the market after listing. Investment banker will not buy in the market, so money issued at the time IPO by selling this 15,000 shares will be paid to promoters. So in this case, promoters stake of the company will be lesser. And if company wants to use this option, that is option of over allotment, they have to specify at the time of IPO, not at later. And this option is used by, and why this name will be given, that green shoe option means at the first time the green shoe company was used this option, so that the green shoe company use na, then the option will be become green shoe options. The concept of green shoe is also used by fund to launch the fund sometimes. So for example, that a wealth launched in private equity funds, so targeted size will be 2000 crore something. After that, it will go for green shoe option 4,500 crores. This means fund plan to rise 200, and if investors, when the more investors will be there, they will rise more shares by using this green shoe option. This is the green shoe option in market will issue. The here also investment banker will play the crucial role. And after that green shoe option, I think we will complete that primary market. In primary market we are completed. In next video I will discuss about direct listing case. I think now only we will complete now direct listing. Direct listing is there. After that we will enter into secondary market, I think so. What is the time here? So we will discuss in next class here.